Problem 12.1 on page 430 introduces us to the first part of cash flow estimation. And the way I think about chapter 12 is in three parts. Part 1 is calculating initial investment outlay. Part 2, which we'll look at in problem 12.2, is estimating project cash inflows. And part 3, which we'll look at in problem 12-3, is calculating something called after-tax net salvage value. So problem 1, 2, and 3 break down each part individually, and problems 8 and 9, which I've also assigned, bring all three parts together. So 12-1 says this: Truman Industries is considering an expansion. The necessary equipment would be purchased for $9 million, and the expansion would require an additional $3 million investment in net operating working capital. The tax rate is 40%. Letter A asks, what is the initial investment outlay? To calculate the initial investment outlay, obviously the equipment itself is going to be involved in this, and that is a $9 million investment. But the net operating working capital is also involved. So I've got to add that to the equipment, and there's an accounting reason for this. When I purchase a fixed asset, which is what I'm doing in problem 12.1, GAAP allows me to roll the cost of spare parts inventory, the cost to prepare the space for the new machine, any cost associated with purchasing and getting this new piece of equipment up and operational can be rolled into the value of the asset. So when I calculate my initial investment outlay, and remember, these are cash outflows, the total initial outlay is going to be $12 million. That's the answer to part A. And again, on a cash flow timeline, I've written a note up here. This initial investment outlay that we're calculating, this is the negative cash flow that happens at time 0 in chapter 11. If you go back and watch the videos from chapter 11, you'll always notice that at time 0, which represents today, there's this negative cash flow. Well, that's us purchasing the asset and all the costs associated with getting the asset up and running. These are all cash outflows, so don't forget that as we work problem 12.8 and 12.9 a little bit later. These are cash outflows on the initial investment outlay. Parts B and C, a couple of terms that you're going to need to know. These are on the quiz. Part B says, the company spent and expensed $50,000 on research related to the project last year. Would this change your answer? In other words, should this $50,000 be included in my initial investment outlay? And the answer to that question is it should not. This is called a sunk cost, and this $50,000 is incurred and expensed whether we do this project or not. It's not dependent on moving forward with the project. It's a done deal. It was done last year. It's already been expensed. So sunk cost, anything that you can identify as a sunk cost, is not a part of initial investment outlay. So make sure you know the term sunk cost. Part C, the company plans to use a building that it owns to house the project. The building could be sold for $1 million after taxes and real estate commissions. How would that affect your answer? And what I want to know is, can you identify this as an opportunity cost? This is the next best alternative for this building. I can either house this new asset or I can sell it for $1 million. Opportunity cost should be included in initial investment outlay. So that's part 1 of cash flow estimation. Problem 12-2 will show you how to calculate part 2, project cash flows.